All right, we're back for another episode of the YVR REMO show. My name is Dean Lawton, and looking forward to jumping into this one. We are going to be discussing the home buyer financing plan. For once, the government has really hit the mark on releasing of a new program, new product that can really help home buyers in Canada. This is intended for first-time home buyers, and we're going to jump into all the requirements and eligibility that you're going to need to know to jump into this and actually take use of this product. And so with that, we have a full roundtable discussion here with Tyler Trumpeter, Derek Williamson joining me, of course, and our two partners from Quasar Wealth Management, Alejandro and Braydon. And so before I pass it back to the group and we get into this discussion, I do have a disclosure to read first. So I'll start with that. Mutual funds, approved exempt market products and or exchange traded funds are offered through Investia Financial Services, Inc. The comments contained here are a general discussion of certain issues intended as general information only and should not be relied upon as tax or legal advice. Please obtain independent professional advice in the context of your particular circumstances. This podcast was prepared, of course, by us, Derek, Tyler, myself at Thrive Mortgage Co., and we are a part of the Mortgage Architects Network, along with the Dominion Lending Center Group network as well. So it's important to understand that along with Alejandro and Brayden, who are investment fund advisors at Quasar Wealth Management, a registered trade name with Investia Financial Services, Inc., and does not necessarily reflect the opinion of Investia. So with that said, we'll pass it off to the table and jump into it. Two individuals here beside us are close friends of ours, close partners of ours. We work with them regularly on our own financial planning. And excited to pass this off to Alejandro to start. Maybe just give us a little introduction about yourself and your company.
Quasar Wealth Management is essentially the wealth division of our company, Quasar Financial Planning Group. Investia Financial Services is our dealer on the mutual fund side of things. So as a whole, see, the big thing about our company and the way that we structure is essentially we're independent financial planning firm. So what that means really in essence is that we're completely independent and we have access to quite a few financial vehicles for our clients. Okay, so no biased approach. And in essence, it just allows us to find single-handedly the best solution for our clients, quite frankly, similar to you guys.
So my name's Brayden Bouchey. I'm Alejandro's partner on the Quasar Wealth Management side, part of Investia Financial Services. I've been with Alejandro for about 2 years now, working together and just trying to grow our book of investment business. And yeah.
All right. So why we're all here, this first home savings account, I mean, there's a lot of options in regards to just how to really benefit from this. Tyler, maybe you can kind of just take it away and what we're getting into here.
Much like the mortgage business, there's no shortage of acronyms when it comes to financial products. So, people listening have probably heard of the RRSP. You've heard of the tax-free savings account. This is the first home savings account, FHSA. Why don't you just briefly just touch on like what is the account and why was it created and who's it going to help?
Yeah. So it was an account implemented by the government this past in 2023. Actually, they're just trying to make it so that Canadians are able to afford housing, and this is just another savings vehicle to help them do so. They kind of took the best parts of the TFSA and the RRSP, where you get a tax deduction for contributions, and then you can pull the money out tax-free when making a purchase of a qualifying home.
Yeah, maybe just touch on the tax deduction just to explain that.
Yeah, so when you make a contribution for the FHSA, it's an annual limit of $8,000. Basically, that $8,000 gets taken away from your taxable income for the year. So if you're a salaried employee, you're potentially going to get a tax refund when you make a contribution on for your marginal tax rate.
Right. So that benefits for the RRSP home buyers plan as well as the first home savings account, correct?
Yep. Yeah, for both of them.
Cool. So who qualifies to open? Sorry, go ahead.
Yeah. I was going to try to put it in simple terms because a lot of people don't tend to understand what a tax deduction means. So in essence, say for simplicity of numbers, let's say that you made $100,000 per year as a gross income. So when you contribute essentially $8,000 into one of these accounts, so whether it be the RSP or the FHSA, what it's effectively doing is reducing your taxable income to as if essentially you made $92,000 a year. Okay, so if you're employed T4 income, okay, what happens is every time that you get a paycheck, essentially your employer is taking a tax deduction every paycheck. Okay, so you theoretically already prepaid those taxes. So at the end of the year, when your accountant does your taxes, okay, they're essentially going to refund the money that you paid on that extra $8,000. So you're effectively going to get a pretty decent chunk back.
So I guess just touching on like eligibility and who can open one of these accounts, if you could touch on that.
Yep. So unlike the RRSP, to open an FHSA, you have to be a qualifying person. So you have to be over the age of majority. So in BC, you have to be 19 to open an account. You have to be younger than 71, and you can't have owned a home that you live in, or your spouse cannot own a home that you guys live in.
Do you know what the mindset is behind the 71 age cap?
So essentially, your RSP, same as RSPs. So the year that you turn 71, you have to convert it into a RIF. So basically an income stream. So that's why there's a limitation. So essentially, because you get a tax deduction, the last year for you to contribute to an RSP is the year that you turn 71. So effectively, it's the same train of thought.
What's like your immigration status need to be? Because we work with a lot of people that, are permanent residents as well. Like, would they be eligible to open this account and contribute?
Yeah, absolutely. So you just have to be a Canadian resident at the time of opening an account.
Okay, and then just to be clear, like a first-time home buyer, again, you mentioned they could own a rental property, but they just never lived in it, so they would still be eligible in that case.
Yeah.
And then if they haven't owned a home for at least 4 years, that would also make them eligible as a first-time home buyer again.
Yeah. So this year and the 4 previous years.
Okay.
Yeah.
Okay.
And then for you can own rental properties, but
Okay.
if you own a principal residence or your common law spouse, etc., owns one, then you're not eligible.
So it's similar to the first-time home buyer incentive. Okay, so contribution limits. Let's jump into that.
The annual contribution limit is $8,000 with a lifetime contribution limit of $40,000. When you open an account, you start becoming eligible for carry forward room. So with that being said, you can carry forward up to 1 year's worth of contributions. So say you opened one this year, put in $2,000 in 2023. The next year, 2024, you could contribute the $8,000 plus an additional $6,000 for carry forward room.
Okay, that's really good to know, and that segues nicely into kind of the deadline for these contributions. So just to be really clear, the trigger is to just open the account, get the account opened, and then you have that carry forward room starting from today, as an example. So super important if anyone is even thinking about doing this, do it immediately. Get the account open. Maybe just before jumping into the deadline for contributions, is there any cost to opening up an account?
So on the mutual fund side, there's what's called MERs on the individual funds. But for each institution would potentially have a different account fee.
So you could potentially be incurring some cost by opening it immediately and not contributing to it. But in the long run, it's far more beneficial to have that carry forward room.
Yeah. I mean, you never know when you're going to get an inheritance or win the lottery or something, right? And you want to, be in a spot where you can maximize your financial situation.
What
Totally
kind
makes
of,
sense.
like, not to quote it too much, but what kind of costs are we talking about? Just like, I wouldn't want someone to be, deterred from this because they think it's a big fee or.
Yeah, no, fees tend to be pretty minimal. I mean, so there's different institutions that you can open them with. You can open through your bank. You can open through an individual institution. You can even open it on some of the kind of cheap online dealers that are available to people today. Really, from a contribution perspective, you're only going to pay an annual fee. That's really what should be kind of deterring you from this. Those fees, depending on who you open it with, can range anywhere from $25 to $100, right, per year, right? After that, the investments and kind of the investment options that you pick will have a management expense ratio plus potential some fees. Having said that, I mean, that's one of the big things that we look at in our planning is it's totally okay to pay fees, right? You're paying fees for a service, you're paying fees for advice, you're paying fees for something. It's just the value that you're getting from those fees have to basically subside what you're getting out of it. So if you're contributing for all six and purposes, $1,000 to this plan just to open it and getting going. Right, again, think about that tax refund. Theoretically, your tax refund already paid for that fee. So you're already ahead of the game.
Plus, I mean, you should be looking at a return of some sort on that investment anyways. That would cover
Yeah.
more than cover those.
Yeah,
two.
and the other thing too is keep in mind these plans are tax shelters. So any growth on the investment is also tax sheltered. So again, that's a huge opportunity for compounded growth, right?
Yeah. Okay, maybe let's just touch on some of the deadlines then for contributions.
Yeah. So with RSPs, you have the first 60 days of the year to make a contribution for the previous years.
Okay.
With the FHSA, it's a little funky. They just set it as December 31st deadline. That's kind of why there's a pretty good rush to get these open
Right.
before the end of the year so that you're able to carry forward some room from this year.
Awesome. Okay.
I get okay, so I'm a first time buyer. I want to access this program. Maybe just very quickly, high level, like how do I open one, and like how do I contribute my money into this account?
There's lots of options out there. Obviously, we can do that. Some banks are also able to open them. It just depends on the institution and doing your research, trying to find somewhere where obviously it's convenient for you, but you have the option to do it as well. And then for contributions, I mean, it's all institution dependent, but most spots you can set up either monthly contributions, you can contribute a lump sum. Again, it's dependent on your cash flow and what works best for your situation.
Yeah, and Tyler, to your point there, I mean, you can't use this as an excuse not to open one. It's super simple to open one, right? I mean, if you were working with somebody like ourselves, you can essentially have a virtual meeting. Essentially, what we need kind of your core information, the purpose of the plan, how you're going to use it, potentially talk a little bit about the investments that you're going to hold in it. What's your time frame, risk profile? I mean, simple questions that we can hash out in a matter of half an hour to 45 minutes. Okay, we can open the plan. You have digital access to the plan, and after that, you can actually transfer funds directly from your bank account digitally to the accounts. So it's not like you're writing checks. It's not like you're going to wait in line. It's not like you're going to do all these things. So we got a pretty quick time frame here to open these accounts. People don't have excuses not to do it.
Probably what's on most people's minds is how do I use these funds, because ultimately this is for the purpose of buying a home and getting that money out of the account. So why don't we just jump into like how can we withdraw these funds and what does that look like?
Yeah, so there's basically two options on withdrawals. First one is what the account's intended for, which is withdrawing for a qualifying home purchase.
Yep.
Which means you're buying a place that you intend to occupy within the year of purchasing it or building it. The second option would be withdrawing as taxable income.
Okay.
If you were in a pinch and you needed those funds, you could withdraw them and access them as income. You pay withholding tax on it, and you're able to use those funds as you will. To make a qualifying withdrawal, you have to have a written agreement to buy or build a qualifying property. You can access the funds up to 30 days after completion date on those. So depending on when you need the funds, again, or when you can contribute to the plan, you're a little bit flexible on that end.
On balance, like very, very similar to the RRSP home buyers plan, right? So obviously they're different programs. So like what would be sort of the subtle differences between the two? And let's say I'm interested in this, but I have RRSP money. Like, is there any opportunity to access this program as well? Can you hold both accounts? Can you transfer money between the two accounts? Maybe just touch on that.
Yeah, absolutely. So you're actually able to use both the RSP home buyers plan and the FHSA to make a purchase of qualifying home. So it just extends your buying power of you can pull $35,000 out of your RSP for the purchase of a home. With the RSP home buyers plan, you do need to pay those funds back into the RSP over the course of 15 years. Otherwise, you get it's taxable income. With the FHSA, you don't need to pay the money back over the course of 15 years. So it's truly tax-free income that you're using to purchase your house, which, I mean, if you're not paying tax, that's great. Also on that, you can contribute up to $40,000, but you're able to pull out whatever the market value of the account is. So there's no limit to what you can pull out to use to buy your house.
One question I have is, so we have like just in regards to like actually being eligible to withdraw this in the process. So I believe there's a form to fill out
prior to withdrawing. Let's say, everything, meets the criteria to pull it out to buy the home. Is there a timeline on before the home completes? Because some people may want to use this for a deposit as an example of time of removing subjects. Can they use the funds for that point in time of the transaction, or does it have to be like near or on the completion date that these funds are withdrawn?
You can pull the funds out. You have to have a written agreement to buy a house before October 1st of the next year.
Okay. So that's good to know. So you could essentially use this for a deposit if your home is not completing for a couple of months. You could use it for the deposit at time of subject removal.
Yeah.
Okay.
I mean, correct me if I'm wrong here. I don't think that there's any actual verification of where the money goes. Like, they need to know that you're purchasing a property, but they're not verifying that you took the money from that account or the RSP account and gave it to the lawyer. Right.
No,
like
no.
I've heard of people using this for like buying furniture and renovations.
Absolutely.
And,
There's no receipts or there's anything that you have to prove. I mean, this is just, it's a qualification to use the plan and to withdraw the funds, right? So to your point, I mean, we've used it with many clients. I'm talking more about the home buyer's plan because this is a little bit new here. But the home buyer's plan, essentially people using it to furnish their homes and that sort of thing, right?
Okay. That's clear. Awesome.
So some on the contribution side specifically is the time frames. Especially with the home buyer's plan and the FHSA. So with the home buyer's plan, essentially you have to ensure that the funds are within the plan 90 days before you pull the money out. Okay, so that's crucial. Again, one of the big things that we talk about our clients, because our clients go, oh, okay, yeah, that's great. The thing about kind of the analogy that I tend to have, buying a house is like buying a puppy. As soon as you start going to see them, you're going to come home with one.
Yeah.
Okay, so you have to make sure that you plan properly. So you're going to use the home buyer's plan. You have to ensure that the funds are there for 90 days. Okay, the beautiful thing about the FHSA is that you don't have to do that. So you can literally put the money in. Okay, it takes a couple business days essentially to set up the plan, fund the program, and then take the funds out. Okay, we can do it on a flick of a switch. So I mean, there's pros and cons to both, but at the end of the day, I mean, you have access to a lot of your funds to use for the purpose of purchasing the home.
So we before we actually got on air here, we were actually talking about just bundling, like some of the strategy around bundling this account with the home buyer plan. Let's just touch on that quickly because you actually had a really good point in regards to like how you could really maximize that for a few reasons.
Yeah, for sure. I mean, the big thing about it, I mean, first and foremost, CRA didn't make it easy. Yeah, I mean, because they decided to come up with a new plan as opposed to just changing the home buyer's plan. Okay, but at the end of the day, because we can still use both of them, it's actually beneficial to clients. The reality behind it is that here, specifically in BC or across Canada, okay, you're probably going to need more funds than this to purchase a home. So the reality is if you have the opportunity to use both accounts, you'd be crazy not to. Because think about it from this perspective, especially if you're buying this with as a couple. Okay, so you can put $40,000 into this account. You can put $35,000 into your home buyer's plan or your RSPs. Okay, so in theory, we have close to $150,000 that you can contribute to these plans. Okay, if you make a fairly decent income, which you have to buy a place here, okay, if you contribute $150,000, let's just say your marginal tax bracket for all intents and purposes between 25 to 30%, you can almost see a refund of close to $40,000 by just using these plans. Okay, it's just contributing, it's taking money from this pocket, shift it to here, and then $45,000 appear that you can now use to buy that home, right? So you'd be crazy not to essentially do some pretty good planning here and utilize both plans to your benefit. And all you're doing is you're using the government's money to supplement your purchase.
Giddy up.
Yeah.
So yeah, like I think you actually made a comment. You'd be nuts not to do this.
I think you'd be crazy not to.
Yeah.
Well, I'm looking at this like the time thing. Like it's sure maybe it's a bit niche, but with the RRSP plan, like it has to sit there for 90 days. Not to rehash this, but like if you're a first-time home buyer, you never set up your RRSPs, you never set up a home buyer plan. Even if you got an accepted offer this week, like if I'm in their shoes, I'm calling you guys and like getting a first home savings account. And if I have money sitting in a checking savings account, say that's 25, 30 grand, I'd whack that into this account. And even if I'm pulling it out again in like 2 weeks, 3 weeks, 4 weeks, I'm getting a taxable benefit if I understand correctly, right? So basically what that means, you're going to get money back, more money than you thought, just for knowing these guys and just for knowing this account exists, even if you don't own any RSPs.
Yep. And on that for this year, you'd only be able to contribute 8,000, but yeah, you'd get the tax refund on the 8,000. But yeah, we've done that for clients already where they were in the process of buying a house and they knew that these accounts were becoming available this year, and on our end, institutionally, they took some time to set up because with all registered accounts, you need to have access to the CRA and they need to set it up on the back end. But once they became available, we were actually able to put some funds in, pull them out after, within the 30 days that they bought the house. So yeah, it ended up just being an additional benefit.
Correct me if I'm wrong, but there's no reason not to do this. But like where my mind goes, someone that's self-employed and is maybe taking money out of their company to fund their down payment, like this makes even more sense, right? Because now you're paying after-tax dollars
For sure.
on your down
So,
payment.
so I mean,
right?
that's an easy way to take money out of your corporation tax-free, right? Because essentially you're increasing your income by whatever you're taking out. Okay, then you're going to reduce it because of the RSP contribution. So kind of those hash out, and then you're going to be able to essentially use it tax-free. So,
Yeah. And outside of buying a home, like you get RSP, you get a tax deduction for RSPs in general, regardless if you're buying a house or not. But we're talking about the home buyer's plan, right? So, yeah.
That's some good strategy there. And I know we've talked about this just before going on air. We will do a follow-up episode just around strategy and how to implement this from a mortgage and real estate perspective. We definitely have some ideas burning there. But I know I know for sure a lot of people are probably thinking like of a few what if scenarios. And like, let's just start with like, how long can you hold this account for? And what happens if you never buy a home?
Because the RSP home buyers plan, if you access funds to buy a house, that's great. It was intended to do that. If you don't, it's there for retirement, right? So with this new account being introduced solely for the purpose of buying a home, CRA kind of protected and made it so that you didn't have just a second retirement account for your lifetime. So with the FHSA, you have 15 years that you can have the account open for. So after the 15th year, you have to close it down. If you don't buy a house, obviously you can either take that, as I said before, as taxable income, or the beautiful thing, which is probably the best feature of this, is that if you don't use it, you can actually transfer it into your RSP and not use your available contribution room for your RSP. So you can transfer it tax deferred, and then it's $40,000 worth of contributions into your RSP.
Right. From a tracking perspective, I've always been curious on this, like who and how is this being tracked? Like someone paying their RSPs back over 15 years, like who's tracking when you hit the 15-year mark on this and it needs to be drawn out? Like who's handling that? Yeah,
that's why it took 6 months for these accounts to become available, just because on the back end, they have to link all their systems and get CRA involved. Every time that you contribute or withdraw from these accounts, they have to contact CRA and have that paper trail of that. So it's all institutions have a direct link with CRA, and they'll be aware of.
So on that RRSP piece, if someone took out the money 2 years ago and they haven't made a single contribution, like they're actually going to be triggered 15 years from that date of withdrawal saying like, hey, this money needs to be repaid.
Yeah. So essentially anytime that you make a contribution, the manufacturers talk to CRA. Right, plus you get tax receipts because I mean, if you put in $10,000, you're going to want to deduct that, so you're going to send that to your accountant. So at the end of the day, everything's linked. So essentially, if you say the home buyer's plan, if you actually take somebody's notice of assessment, it'll actually say how much you owe and when you have to start repaying. Right, so how you repay it, and I mean that's actually something that maybe we can talk about. The repayment period is 15 years after 2 years of you actually making the purchase. So theoretically speaking, in today's world, it's approximately, if you take the full $35,000, it's approximately $240 a month. Okay, so the reality behind it is as soon as, and this is why people kind of say, oh, maybe I shouldn't use that plan because I got to repay that and I'm going to put $35,000 into my RSPs fairly quickly. You don't. And the reality behind it is you shouldn't. You should actually take as long as you possibly can to repay those funds, because anytime that you're repaying into the home buyer's plan, you're not getting a tax deduction with those contributions. Okay, and instead, if you make an additional contribution, you do get a tax deduction. So take the 15 years to repay that. Right? There's other opportunities. If you don't repay it, it becomes taxable income. So, for example, if you go on maternity leave, right, and you don't have much income that year, okay, you don't have to repay that year's contribution. Take that as taxable income, because essentially you're just not putting it back into the RSP. So there's different opportunities. It all comes to planning, and that's one of the crucial things about, whether you're using the home buyers plan or the FHSA or TFSAs or whatever it is. Truly comes onto pure planning. Everybody has a different situation. There's no cookie cutter financial planning. So if you want to maximize the use of these plans and really take advantage of them for your personal situation, you got to do some proper planning.
One thing that's just coming into my brain here is just as I'm thinking about this. So I just want to go back to qualification for 1 second. So when you open the account, there's a qualification process, and then when you pull the money out, there's also a further qualification process to ensure that you're eligible. When opening the account, how in depth is that qualification process? The reason I ask that is, like, I could be a homeowner now. Maybe I plan on traveling abroad for 4 or 5 years, and I want to save and contribute to that plan and use it when I come back. So I wouldn't qualify, so to speak, right now to open that account. Would they still open the account for me, or how would that work?
Yeah, so you can't be a homeowner of a primary residence
Even
to open the account. Otherwise, everyone who owned a home would open this and then just transfer the funds on a tax deferred basis to the RSP after 15 years.
So basically, I'd have to leave. Well, basically, I'd have to sell my home then, or I've stated I'm living in a rental.
So again, I would say planning.
Yeah.
Because you can still contribute to your RSPs, right? Eventually sell that home. Okay. Qualify for the 4-year period plus one. Yeah. Come back, transfer the funds from your RSPs to your FHSA. So there's still an opportunity there.
Okay.
Right?
Interesting.
So it's all planning.
Yeah. Yeah. I mean, that's clear. It really does come down to planning.
Yeah. It comes down to planning.
Yeah.
100%.
Okay. So I think we'll kind of just start to wrap this up. I mean, if I was to pass away, what does that look like?
Yeah. So like your TFSA, RSP, you can have either beneficiary or successor holder. With that, there's a little bit difference on that for successor holder. If they were to receive it when you passed away and they already own a home, they'd actually have to transfer that into the RSP or take it as taxable income. If they weren't, or if they were a qualifying first-time home buyer, they could just transfer the account. They'd be the new owner of the FHSA. For the beneficiary, it would be, again, they can't transfer the account. It'd be the amount. They could transfer it to RSP or take it as taxable income as well.
So I think a pretty important planning differential kind of identity that people are not aware between successor holder and beneficiary designation. So successor holder, in essence, tends to be a spouse, okay? Or to qualify as a successor holder tends to be a spouse. Yeah, beneficiary can be anybody. So registered plans for RSPs, TFSAs, FHSA, in essence, you can actually have a beneficiary. So essentially bypasses the estate because there's tax planning opportunities there. Yeah, the big thing about the successor holder, and this applies to the TFSA too, which is super important for people to know, is that if you actually name your spouse as the successor holder, if you were to pass away and they have, let's say, a max out TFSA, okay, they get to keep their TFSA, plus they get to acquire your TFSA in TFSA format, and you get the entire contribution room as well. Okay, so that's huge. It's massive because it's an immense amount of tax shelter funds. Okay, if you name them as beneficiaries, okay, that's not going to happen. Okay, so again, comes back to planning, proper planning.
Yeah. Well, I mean, that's some really good info. Is there anything else that you guys think we should add here? I mean, I feel like we covered it all.
Hopefully you had life insurance from Quasar if you passed away, I guess.
Yeah, good point. Well, that's awesome. I think, we definitely succeeded here because we really just want to make this as informative as possible and, be able to walk away from this episode and really have a good idea of understanding of what this is and how to utilize it. Again, we'll get into strategy. There's a lot of ideas already percolating, so we'll get into some strategy on a later episode. But yeah, thank you so much for joining us, and we'll definitely include all your info in the show notes here below. For anyone that wants to reach out, don't hesitate to reach out to us directly, and we'll make an introduction, or like I said, reach out to the gents here yourself, whatever works best for you. Thank you so much for joining us, and yeah, we look forward to the next one.
Appreciate it,
Awesome.
guys.
Thanks, guys.
Yeah.